The repo rate. Sounds complicated? It's not. It's a number that impacts all of us. It affects how much we pay for our loans and how much we earn on our savings. Think of the repo rate as the price of money. The Reserve Bank of India, or RBI, sets this price. It's the rate at which banks borrow money from the RBI. Why should we care? Because this price affects everything. It influences interest rates on loans, the returns on our savings, and even the prices of goods and services. Understanding the repo rate empowers us. We can make informed financial decisions. Let's dive in and demystify this important financial indicator. Imagine a bank needing quick cash. It can borrow from the RBI. The interest rate on this loan is the repo rate. The repo rate is a short-term lending rate. Usually, it's for 1 day. Banks use it to manage their daily cash flow. When the repo rate is high, borrowing from the RBI becomes expensive. Consequently, banks might increase the interest rates they charge on loans. Conversely, a lower repo rate makes borrowing cheaper for banks. This can lead to lower interest rates on loans for us. The repo rate is a key tool for the RBI. It helps control inflation and stabilize the economy. The RBI constantly monitors the economy. It looks for signs of inflation or slow growth. Based on its observations, it adjusts the repo rate. High inflation is like a fever for the economy. To cool it down, the RBI might increase the repo rate. This discourages borrowing and spending, which helps curb inflation. On the other hand, if the economy is sluggish, the RBI might decrease the repo rate. This encourages borrowing and spending, giving the economy a much-needed boost. Remember the seesaw? The repo rate is like the pivot point. The RBI adjusts it to maintain balance in the economy. Planning to buy a house or a car? The repo rate plays a crucial role in your loan. When the repo rate rises, banks usually increase interest rates on loans. This means you'll pay higher EMIs. Conversely, a lower repo rate can translate into lower interest rates on loans. This makes borrowing cheaper, making that dream car or house more affordable. The impact is significant on long-term loans like mortgages. Even a small change in the repo rate can affect your monthly payments considerably. Keep an eye on the repo rate trends if you plan to take out a loan. It will help you budget effectively and secure the best possible interest rates. Section 5, Savings and the Repo Rate, a tale of two sides. The repo rate doesn't just affect borrowers, it impacts savers too. But, the relationship is a bit complex. In theory, a higher repo rate should lead to higher interest rates on savings accounts and fixed deposits. This is good news for savers. However, banks don't always pass on the full benefit of a repo rate hike to depositors. They might prioritize maintaining their profit margins. Conversely, when the repo rate falls, banks tend to reduce interest rates on deposits faster. This is because they need to protect their lending margins. The impact of the repo rate on savings depends on various factors. It's crucial to compare rates offered by different banks to ensure you're getting the best returns. Inflation is the rate at which prices increase. It eats away at our purchasing power, making things more expensive. The repo rate is a key weapon in the RBI's fight against inflation. When inflation is high, the RBI might increase the repo rate. This makes borrowing costlier, discouraging people from spending excessively. Reduced demand can help cool down inflation. Conversely, when inflation is low, the RBI might lower the repo rate. This can stimulate the economy and prevent deflation, a situation where prices fall. The repo rate and inflation have a close relationship. The RBI constantly adjusts the repo rate to keep inflation under control and maintain price stability. Planning a big purchase? Whether it's a new car, a house, or a fancy gadget, the repo rate can affect your budget. When the repo rate is high, borrowing becomes expensive. This might push up the prices of goods and services, especially those bought on credit. If you're planning a significant purchase that involves financing, keep a close eye on repo rate trends. A rising repo rate might mean you'll have to shell out more for the same product. Conversely, a falling repo rate can make borrowing cheaper, making big-ticket purchases more affordable. You might even snag a better deal due to lower interest rates. Timing is everything when it comes to big purchases. Understanding the repo rate can help you plan and make the most of your money. Let's look at recent examples to see how the repo rate plays out in real life. In 2023, the RBI increased the repo rate several times to combat rising inflation. This led to higher interest rates on home loans and car loans. As a result, many people postponed their big purchases. Those who took loans had to shell out higher EMIs, impacting their monthly budgets. This illustrates how the repo rate can have a direct impact on our financial decisions and spending power. Experts believe that the RBI might continue to increase the repo rate in the near future. This is to curb inflation, which is still a concern. What does this mean for you? Be prepared for potentially higher interest rates on loans. This might make borrowing expensive, however it could also mean slightly better returns on your savings. Stay informed about the repo rate and plan your finances accordingly. Understanding this crucial financial indicator can help you make smart decisions and achieve your financial goals.